or convince me that it should be true. That's the test. You convince me that it should be true.
In order to calculate owner's equity off the ads, we're going to subtract liabilities from assets. Accounts receivable is a current asset, so that would increase that.
Remember, equity is assets minus liabilities, and assets are current assets plus net fixed assets, and accounts receivable are part of current assets. So if all else equal, an increase in accounts receivable means an increase in assets, which immediately implies, everything else being the same, an increase in equity. That would be a perfect explanation. Okay? It's obvious, is not an explanation. That may be the reason why you picked true. The test is not to know why you picked it. The test is you convince me that it should be the right answer. Okay? That's your goal in that part of the exam. Otherwise, I would have just did a quiz and we would have been done with it. But you're already doing that at home anyway. There's no purpose to that assignment. Since accounts receivable is an asset, this means total assets go up, thus equity. Even something that's as cryptic as that, I would be fine. This is not an English class. I'm not going to worry about your grammar or your spelling. Your handwriting, remember, if I have an easy time to read what you're writing, I'll be your friend. So write better than doctors. And that's the definition, so I'm not going to worry about that. Okay. There's a good chance that you'll see questions like these. At least one. Which of the following are included in the market value of the firm, but not in the book value? So what do you think? In this case, your test is figure out which ones. The technical knowledge of the employees. Would that be part of book value? No, because remember, accountants need a standard to figure out what value to attach to that. If, that's definitely an asset, but it's not an asset in book value. So it's not going to be in book value, but if your employees are technically competent, that adds overall value to the firm. If people know that, they're going to attach value to that. So one is the case. Quality of the management team. Yes or no? Should be. Experience of the employees, how about that? Same deal. Similar reputation of the firm. All of those will have zero value in the books. You have no way of attaching a value to that. But the market does. Whether or not you agree with that, that's besides the point. That's why we call it the market value. If tomorrow there's a scandal in a firm, that's not going to affect the book value at all. But that scandal is going to damage the reputation, and the market is going to go ahead and dump it. If tomorrow CEO of Google is found that he was a client of Jeffrey Epstein, you can bet everything you own that Google stock is going to go down. By how much, I don't know. But that's reputation. or quality of the management team, what have you. Let's leave something for those people who actually watch the video, or those people who are not here. If they simply want the notes, good luck with that. I'm not going to work for them. I don't have to market. Okay, that's another one. When you get a multiple choice, especially conceptual one, the way you figure out an answer is which one is the most correct. Sometimes there are two options that may look correct, and by themselves, I would have accepted them separately as true or almost true. But in multiple choice, you have to pick one. Okay? Which one is most likely to be the case? When and if that happens, I typically give you partial credit, even if you picked the incorrect one. I mean, it's not just a bad answer, but I'm not promising that will always happen. It depends upon, what the question is and how I'm feeling when I'm actually grading these. That's why I grade them at the same time, question by question. Let's see. Book values are affected by depreciation method used. Yay or nay? Of course, definition of book value is historical cost minus accumulated depreciation. So there are different depreciation methods. For example, straight line calculates the depreciation equal amount over the tax life. Makers, it's accelerated, so it does affect it. Both the book value and the market value of land decreases over time. Yay or nay? So when you pick one of these, you have to make an argument why that is correct, but that also implies the others were not. So make a brief argument about why they're not correct as well. Book value obviously will decrease over time because even for land, there is a little bit of depreciation. But market value may or may not. It depends on the market. Market values are more predictable than book values. In fact, it's the other way around. If I know the acquisition cost and I know the depreciation schedule, I can predict the book values to the dot. But market values are subject to the whims of the market. Back in 1989, a one-bedroom apartment in Tokyo probably cost the equivalent of $1 million. In 1995, that same apartment was less than $250,000. That's still a lot of money, but that's Tokyo real estate for you. It just varies. But on the books, if you bought it at $1 million, there is certain depreciation about it. You know exactly what's going to happen. Market values must be greater or equal to book values. The example I gave just belied that. And there is no such thing. In general, in real estate, that is true, but the depreciating assets especially, that's not. I bought this computer about 4 years ago, and I paid $1,300 for it. Technically, I didn't pay for it. I had development money. You get a budget for certain things. If I wanted to sell this, even without any scratches on the screen and stuff, I don't think anybody's going to pay me anything more than $250 over it. Okay? It has only 16 gigs of memory, which was good 4 years ago, but it's nothing these days. And the book value of an asset can increase over time? No, it cannot. Even with revaluation, that's not allowed. There is only one thing that you may think could increase, that's goodwill. Goodwill, the excess money you pay for an acquisition over and above the book value. Every year that is subject to impairment test. For example, MySpace, Wall Street paid $500 million for MySpace. And obviously, it's not worth the letterhead now. And, Wall Street Journal had to recognize that. But Google bought YouTube for $1.5 billion in 2004. And these days, Google is responsible for at least 1/6 of Google's revenue. So Google being $1.8 trillion, a rough valuation for YouTube it should be worth $300 billion. But you will never see YouTube as a $300 billion asset. You cannot revalue goodwill. But if it goes on, you do. Obviously, other fixed assets are subject to depreciation anyway. Yes.
I was going to say about that real quick, because not only expenses, but also when you tend to try and buy stuff for a bunch of money, or you tend to buy very large companies and assets, you actually have to spend quite a bit of money on PR relations with the employees that were previously employed, the rights, and also just in general, you have to make sure that your name is good when you purchase it, because a lot of controversy.
Yeah, that's the acquisition cost. We're talking about here what happens to that value over time.
Right.
That value will never go up. The book value, the market value will. If somehow Google decided to sell YouTube today, I don't think they would have sold it for less than $500 billion.
Particularly with inflation as well, it would further depreciate the value of that if you were to actually sell it.
Yeah, accounting doesn't know anything about that.